Alright, hello everybody and welcome to my very first video on penny stock trading. This is not going to be an all-encompassing video by any means. You're not going to watch this one video, walk away from it, start trading and make $1 million in your first week, but I do hope that it can lay a good groundwork for you to go out, watch more videos, hopefully from me, in the coming days and weeks and acquire more knowledge on this topic because it is so incredibly useful and it has so much potential for everybody out there, because I truly think that if you have the right amount of dedication and you put enough time into it, you can learn to trade these things successfully. But first of all, I do want to offer up a disclaimer here. I'm not a professional and I am not at all certified to be teaching these things. Leave that up to your own financial advisor, and never act entirely upon my advice if you do not share the same thoughts as I do. Always do your own research too, because although penny stock trading can be hugely profitable, it can also be extremely risky. The vast majority of traders, I think around 90%, actually do end up losing money. So trade with caution and never trade with more money than you are willing to lose. Do not trade with the money that you need to pay your next car payment. That is a horrible idea. Please do not risk anything like that. Okay, now that we've got that out of the way with, let's go ahead and go on to our very first subject. What are penny stocks? If you're going to trade them, you better know what they are. And as the name would suggest, they are stocks which are technically under $1, but now the discussion of them has kind of expanded out to slightly higher priced stocks. Nothing super high, nothing like Apple or anything like that, but I'd say usually around $5 and below would be a good benchmark. Sometimes you're going to be trading a little bit higher, sometimes you could be trading at 2 cents a share. It just really depends quite a bit. But something that is common among all of them is they do have a low float and a low market cap. Now don't worry, I am going to explain to you what those are. A float is the number of shares that are actually available to trade. So the lower that number is, the easier the price is going to be driven up, because the more demand that there is, the less supply there is. Obviously, the price will have to rise to accommodate that basic supply and demand. And then the market cap is the price of the stock times the number of shares outstanding. Basically, this is a very rough way to gauge the market's overall valuation of this company. And it can really vary quite a bit. But for the sake of discussing penny stocks, we're going to look for stocks which have a market cap of around 50 to 100 million. And although that may sound like a lot, that is extraordinarily small when you're looking at other companies which are well into the billions. So from Wall Street's point of view, these stocks are tiny. And then a low float would usually be considered around 1 to 5 million. And then next up, the low float and the low market cap affects the volatility. And that isn't a real indicator. It's not anything that you're going to find when you're trying to refine stocks on a screen or anything like that. The low float and low market cap do contribute to the stock's ability to swing wildly in price. And if you do want the potential for profits in these penny stocks, you are going to want a lot of volatility, because sometimes they could swing up 50, 100, 200%. It can get crazy, much crazier than a stock like Apple ever could, because it is just too tame. There's too much of it. The price is too high. And these same penny stocks are also traded on most exchanges, but most commonly over-the-counter or OTC. If you're a new trader, I would recommend steering clear of these, because most of them are not electronic, so it can take a while for your order to actually be executed. However, they are listed on more traditional exchanges such as the NASDAQ, New York Stock Exchange and all that. The NASDAQ, I'd say, is probably best for beginners because it offers very speedy execution and usually a pretty good quality of penny stocks. But as my next point says, most importantly, 99% of the time, these penny stocks are going to be very bad companies which will provide negative returns in the long run. So don't ever get into one of these stocks thinking that you're going to have the next big company like Amazon. You know, you see those ads all the time where, oh, if you had bought Amazon in 1999, you'd be a millionaire today. But the chances of getting an Amazon company in this stage are you will go broke before you get one of those. It will not work. I can guarantee you that. So never get into a stock thinking, I am going to retire on the $1,000 that I put into this, because you never will. But you may be able to make money off of other people who do think that. So, with the right timing, coupled with the right news, the right chart pattern, all of that, you can make a lot of money from them. Okay, so now that you know what they are, let's move on to why you should even bother trading them. First of all, something that you need to understand is that they are much riskier than the common stocks that you're going to be seeing when you flip on CNBC or Fox Business. They're smaller, they are much more agile in price, if you want to think about it that way. They are wild and they are untamed. So if you're wanting to have a safe little fund and maybe go invest in Apple or Amazon or Microsoft, something like that, a company where it is going to be very steadily growing over time, but you won't be making very much money if you don't have a lot of money to put into it in the first place. So that's why these are great opportunities for accounts which don't have a lot of money, because they may swing 20%. You know, you could potentially double your account pretty soon. It could go from 500 to 1,000 to 2,000 to 5,000 to 10,000 to 20,000 to 30,000. It does have a snowballing effect, and once you get up to that 30,000, of course, that doubles 60. There is a snowballing effect. So you started with 500, and you could be up significantly in maybe just even a year if you are lucky. That I cannot stress that enough. Do not get into it thinking that it is a get-rich-quick thing, because it is not easy. But if you are really good at it, you can become rich quick. And many successful traders, the ones who do get rich quick, are only trading part-time. I mean, from maybe 8:30 to 11, take a lunch break until 3, trade for about an hour, and then that night do a little bit of research for 45 minutes. And it is entirely realistic to think that you can be part-time trading and making way more money than your friend or your neighbor working the 9-to-5 job. And anyone can do it regardless of how much money they have. You could start with $500, $1,000, $1,500, $2,000 if you wanted to. I wouldn't recommend necessarily starting with anything less than, well, probably 1,000, if I'm going to be honest, because in the beginning you probably won't be too great at it, and commissions will be eating into your profits. Commissions aren't very much, but $1,000 would probably be pretty great. $1,500 might be better, just so you have some pillow money. If you fail, you've got something to bounce off of. Finally, they're pretty easy to learn if you are dedicated. You can really learn the vast majority of what you need to know to trade them well in a very short period of time. You could begin trading in a week or two if you were really dedicated. If you treat this like a college course, then absolutely you can go ahead and start making money pretty soon. Not after you watch this one video, but after you watch many, many, many hours. Really engulf yourself in information all about all of it. And the more that you know, the better. It literally cannot hurt you. So I bet you're wondering now, okay, great, I want to trade them, but when do I trade them? And this is kind of a point that I just touched on, but I do want to go ahead and lay the groundwork just so this is all out in the open. First of all, the market does open at 9:30 a.m. Eastern Standard Time in the US, of course. The most action typically happens from around the market open at 9:30 to around 11 a.m. And then things will drastically slow down on a normal day. And then they will start to pick back up around 3, and then finally when the market closes at 4, that'll be at the end of the day. However, the hour or so before the market opens at 9:30 is a great time for research. This is during the time called pre-market, and although that you can technically trade stocks during this time, which is from 4 a.m. to 9:30 a.m., I really wouldn't recommend it for a beginner because things can get dicey. If you try to buy it during pre-market, it may not get executed until right when it opens, and then a million other people have your exact same problems, so you end up losing money. It can be a real mess, and you should really know how to do it before you try it. So use this hour or so before market opens to try to find good stocks. I'll explain how to do that and what you're looking for in a couple of minutes. And use it for research pretty much. And then again, the night before the market opens can also be a great time to do it too for the next morning to research. There will be a couple stocks popping up that'll be new runners for tomorrow. But generally, when you're researching at nighttime, you're going to be wanting to look for stocks which had already run that day, the day of the night that you're researching. Because they'll still be up there. Maybe you'll get a little action from the aftermarket hours, so you can just see what is still sticking around, what could be going on a second day run, what had a small first day run but could be ramping up to have even a bigger second day run. So that is when you trade them. Now let's go over the basics. What do you need to start? You really only need 3 things. You need a brokerage account. These can be set up extremely easily and free. Some of the popular ones are E-Trade, Charles Schwab, and TD Ameritrade. And although many people will try to tell you to use Robinhood because it does look great on paper, this app that, no commissions, you completely free trades, and you get to do it all from your phone, it is not that great. The charts are not great to begin with, but second of all, those no commissions, that does come with a price that you're not going to be paying up front. And the price is the execution time is not great. It cannot compete with something that other brokerages like E-Trade can give you because they take too long, and then by that time, if you meant to be buying the stock while it was still rising, it could be crashing at that very moment, and then you have lost $1,000 trying to save 10. So steer clear of Robinhood. Don't miss a dollar trying to pick up a penny, or whatever the quote is. I'm kind of blanking on it right now. But anyway, second of all, you're going to want a stock screener. These actually help you find the stocks, and believe me, it is not as hard as it would seem, because although there are, well, that's kind of a good question. I'm not exactly sure how many stocks there are out there, but I would guess in the millions, probably, maybe only thousands, probably only thousands. The screener can set up different parameters. It can filter things out for you. For example, if you only want to show stocks that are below $7, you can do that. And it makes it all very easy and very clear, and there are several good free ones as well, such as TradingView and FinViz. They're both very good. And finally, you're going to need a charting app. Obviously, one of the most important aspects to analyzing penny stocks is the chart, because when you're looking at penny stocks, you're not analyzing the fundamentals as much as Warren Buffett is when he's trying to decide to invest in a multi-billion-dollar company. You're going to be reading the chart more than anything else. So obviously you're going to want to have the best. In the beginning, you can start out with something free, like, once again, TradingView or FinViz. There's absolutely no shame in it, and they are surprisingly good. One thing that I do have, a little hint at the bottom here, use candlesticks. And there are many different chart types. The one that you're probably most familiar seeing is the line, where it is just a line. It's the kind that you plot in school, X, Y, all that sort of thing, connect the dots. But you're going to want to use candlesticks because they are way better and more detailed, and they are amazing. They will change your trading career. And I'm going to make a whole separate video, or maybe even series of videos on charting, because it is so incredibly helpful. I cannot think of any skill which is better to have if you're penny stock trading. I really can't. It is the by far the most essential one. So I'm going to be making more videos on that topic, so please stay tuned and subscribe for that. But for now, let's go on to how do you find the good ones. This is where your fancy new screener comes into play. Use it to set up various parameters. First of all, you're going to want to sort by highest percent gainers. So, if the highest moving stock in the world, or at least in America, moved up 250% today, and the second one moved up 200% today, it'll show you those in order, 250 and then 200. And then the list goes down from there. So that is probably going to be most helpful for most of you to sort it that way. It is most helpful for me. I can't think of any other trader that I've ever listened to that has it set up any other way. And for that reason, it is actually the default option on most screeners, I believe. So next, after that, you're going to want to begin to filter out stocks which do not meet your requirements. Many people who are focused on penny stock trading would exclude stocks which are above a certain price, like maybe $7. That's very arbitrary. Maybe make it 10. Think about which price you're most comfortable trading and just set it at that. Because there are going to be a few stocks which are above your comfort range and a few that are maybe below. So just keep that in mind. I don't really want to recommend you a very hard number here because it can change. You should be the one making that decision. But remember, we're looking for penny stocks. Do not learn all about penny stocks and end up buying a $100 stock. That would be a horrible decision because none of the same rules even apply. Next, you may want to exclude stocks which do not have a volume of at least 500,000. A volume is a measure of how many shares of the stock are being traded, and it is very important in making sure that the stock is liquid. Liquid means that it has both the potential to move as well as it is easy to get shares of it, to get your order executed. If it is illiquid, you'll have a very difficult time getting your shares executed, and you may not be buying the shares at the right time. You could end up losing money because in penny stock trading, they do move so incredibly fast. Every second is worth everything. So if something like that is going to cost you time, you better make sure it doesn't. So for that reason, I'd absolutely make sure to exclude stocks which do not meet the volume criteria. Lastly, many traders choose to only see stocks which have a market cap of less than 100 million when they're trading penny stocks. And maybe broaden that out a little bit. I think that it could be a little bit higher just to make sure that you don't miss out on any action as long as it still does fulfill the other requirements. So that is very flexible. Much like the price, you can adjust that for yourself. And then finally, you can also refine which exchanges you want to see. So a new trader may not want to see OTC stocks. That's fine. You can take those off this screener, and then you're only left with ones that you want to trade. Then after you've done that, now you're going to want to take a look at the remaining ones. You're going to want to take a look at the news. Is there any? Is it good? Is it speculative? Why is the stock running? It should have news most of the time, and especially when you're starting out. Make sure that it is, most of the time you're not going to want speculative news. For example, an announcement, well, not even an official announcement, but maybe some buzz around a certain stock saying that they may have a panel coming up in which they may announce a new groundbreaking product. That is, maybe that isn't the best example because that isn't horrible news actually, and that is pretty okay. But the best case scenario would be, oh yeah, you know, a company with ticker XYZ announced a new robot product available in 6 months. That would be very solid news, and you could totally trade that, assuming that the price is going up, because you never just want to see a stock that has good news and trade it because of the news. You trade the reaction to the news. You don't trade the news itself. So you wait and see if the news gets a reaction, and if it does, that's when you can trade it. No news on a stock that's running with no news. It could be a variety of things. It could even be a pump and dump scam, which is something that I should probably make a separate video on entirely because it really does deserve it. It is fascinating to learn about. But just in the beginning, don't trade a stock that doesn't have good news. And then once you have found that good news that you're looking for, time to take a look at the chart. As I mentioned earlier, I am going to be making a lot of videos on how to read charts because it is by far the most important skill when you're learning penny stocking, but there are a few basic rules of thumb that I can go ahead and toss in right now. Make sure that the stock has been active in the past and has a history of spiking in price. If you are buying a stock with the expectation that it is going to shoot up 50%, and you can make, 30% from that move, you're not going to want to buy a stock that has never done anything like that before. You're going to want to buy a stock that has a history of doing this sort of thing. Stocks repeat themselves. They are predictable if you look at the patterns. They're very, I hesitate to use the word easy, but they're very readable. Because they do truly, history repeats itself as far as stocks are concerned. So never hope that a stock will miraculously do something good that it has never done before. Now I hesitate to say never hope that a stock will miraculously do anything that it has never done before, because it could do something bad that it has never done before. That is possible. And then make sure that if it has spiked in the past, you want to look at how it's reacted after the spike. Does it hold? Does it fade immediately? Does it maybe hold for a day and then crash at market open next day? There are just a variety of things to look at here. And look for stocks that are breaking out. What I mean by that is when you look at stocks chart, oftentimes you're going to see several mountaintops, sort of. And usually most of them are going to be at the same level. But what you're going to be hoping for is the current day price, the one that you're watching right now. Hopefully it is breaking out above those other mountaintops. Mountaintops form usually a straight line called resistance. And so, for example, if a stock has had really good news 3 times in the past year, and each time that good news causes it to only go up to $3, then it is perfectly reasonable to assume that the 4th time it does have really good news, it will only go up to $3 again. But let's say that it goes up to $3.20. That could be a sign of conviction on behalf of the collective market. And that could cause a lot of people to go ahead and start buying it, which could cause a further spike up to maybe $4 or even more. But don't trade it. Don't buy a breakout just because it's up to 301. You want to, that could be just even an accident. So you want it to be convincing. You want to make sure that, okay, it has broken above this line of resistance, as it is called. And that is probably one of the most helpful ways of buying stocks in the very beginning. But there are a variety of other strategies like buying the dip and so on that I can go into in other videos far more in depth, but I don't think that this is the right time for that. And one more thing, do not trade charts which are choppy and seemingly erratic. I mean, it seems almost obvious, but you don't want to trade something where it doesn't seem predictable at all. Because as I mentioned earlier, most charts are going to be readable. But if it looks like the line on a liar's polygraph test, you are not going to want to even touch it. And lastly, never trade a stock after it has already run too much. This happens all the time to most traders. They find a stock, it's up 15%, and you debate buying it. Then 10 minutes later, it's up to 70%, and you regret not buying it. But you've already missed out, so you're going to go ahead and buy it right now, 70%. And the moment that you buy it, it crashes back down to 50%. You never want to chase a stock. You don't want to have the fear of missing out. Because trading it after this point, when it's already run too much, it will likely result in a loss because this price, 9 times out of 10, is going to come back down. So next up, how do you trade them? After you found something that you do actually want to trade, load up your brokerage account. It's time for that third one to come in. Type in your ticker, fill out how many shares you'd like to buy, never risk the majority of your account on a single stock, and execute. Depending on what kind of order type you have limit, you may get really lucky and be able to have a market depending on how highly priced the stock is. You're going to have to read your brokerage account's individual policies when you actually go to buy them, so it does vary a little bit. I won't go into that much detail here because I'd have to probably make a few different videos on different brokerages and all that. So after you do hit that execute button, your heart will be racing and your stomach may be a little bit queasy, but do your best to remain coldly detached and just watch the numbers. Don't start thinking about the money, because if you're doing what I've told you, the money hopefully won't mean that you will miss your next car payment if you lose it. Don't risk anything that you can't afford to lose, right? So just watch the numbers and you will do far, far better. And if things aren't going your way, just sell your position ASAP. It is better to be safe than sorry. Traders who do not abide by this rule will not last long. That I can guarantee you. And if things are going your way, don't get greedy. Determine how much could reasonably be made before entering and stick to it. If you think that you're only going to make 20% on a trade, best case scenario, and it is up 20%, don't say, hey, I'm going to cross my fingers and hope that it goes up to 30. It's not worth it because it could crash back down to 5. And then, oops, you've only just made enough money to buy commission, or, to pay for commission, and now you could have made some money, but you didn't. Okay, so that just about covers it for my very first video here. I hope that it gave you a good kind of cursory glance at what you're hopefully going to be getting into. Like I said, it is not an all-encompassing video, and you're going to need to learn a lot more, and I plan to help you do that with a ton more videos in the next few days and weeks, and I really hope that I can help you understand all of this very well. Because, like I said earlier, there's a lot of potential here. So drop a like, definitely subscribe, that way you don't miss any upcoming videos all about charts and floats and all that exciting stuff, which will hopefully pay off and make you a lot of money in the long run. So thank you for tuning in, and I will see you again very soon. Bye.